Imagine clicking one button and owning a slice of an entire market, then letting time, diversification, and low costs do the quiet compounding work in the background. That's the promise of index funds, pooled investments designed to mirror benchmark returns with minimal trading, minimal guesswork, and a clear link between your portfolio and the market you intend to track. The result is a simple, rules-based way to stay broadly invested while keeping fees and decision fatigue low enough for compounding to shine. An index fund's mission is straightforward. Match the performance of a defined market index like a total U.S. stock market or the S&P 500, rather than trying to beat it, which reduces forecasting and manager discretion. To do that, the fund holds the same or a representative sample of the same securities as the index, in the same weights, and adjusts as the index rebalances or reconstitutes its members over time. Because the objective is tracking rather than predicting, these funds typically trade far less, which lowers costs and helps performance net of fees stay close to the benchmark. What is an index, exactly? It's a rules-based basket that represents a specific slice of the market, from large-cap U.S. stocks to the entire global equity set, or from core bonds to municipal debt. Most broad equity indexes use market cap weighting, which means larger companies naturally carry larger weights, letting the portfolio adjust automatically as values change without constant active intervention. Variants exist equal weight, sector-specific, or style-tilted, but the broad, cap-weighted benchmarks tend to reduce single-name concentration risk while remaining investable at low cost. There are two common ways index funds track: full replication and sampling. Full replication means owning every constituent in the benchmark at its corresponding weight, which minimizes tracking error but can be operationally intensive for very large or complex indexes. Sampling holds a representative subset that closely matches the index's characteristics, aiming to keep costs down while maintaining tight tracking difference in practice. Either way, your goal as an investor is small, consistent tracking difference and low volatility of that difference, known as tracking error, so the experience stays close to the index you chose. Costs are destiny in long-term investing, and index funds are built to keep them low. Lower expense ratios and lower turnover reduce the two big drags that quietly erode compounding over decades: management fees and trading costs. Many index funds also minimize cash drag and handle flows efficiently to keep performance near the benchmark, further shrinking the gap that fees and frictions can create. The compounding effect here is subtle. Shaving tenths of a percent each year adds up to large differences over a long horizon. Diversification is the other quiet edge, because broad index funds spread your exposure across many companies, sectors, and often countries, reducing the impact of any single failure. This breadth helps portfolios absorb rotations and shocks, which matters because staying invested through cycles is the toll for compounding's most valuable miles. While diversification can't eliminate market volatility, it can lower portfolio-specific risk enough to support the discipline needed to keep buying and reinvesting when prices wobble. By the mass just quass the five and de covered him, when that redder him, and the mass the five and destivant, and tellin sighs have covered justivant. When the mass just crive salivant, he one of him south, and the mass just, the pand of the markable wive and medianomus. Why do index funds often beat many active approaches after fees and taxes? Because while outperformance happens, it has been historically inconsistent to identify and stick with long-term active winners, net of costs. Many active funds struggle to beat their benchmarks over multi-year windows, and higher expense ratios plus tax-inefficient turnover make the hurdle even higher. Passive strategies don't promise outperformance. They aim for reliable, benchmark-like returns with structurally lower costs and fewer behavioral traps, which frequently wins in real investor portfolios. Taxes amplify the case for indexing, especially where turnover is low. Fewer trades can mean fewer capital gains, distributions, and pairing broad index funds with tax-advantaged accounts can keep more of your return compounding each year. In taxable accounts, focusing on efficient index funds and long holding periods can reduce realized gains and distribution taxes, improving after-tax outcomes without extra complexity. In the U.S. account landscape, index funds fit naturally. Workplace plans, like 401, CAS, and Roth 401, CAS, often offer broad market index options, making it easy to tie payroll deferrals to a low-cost, diversified core. IRAs and Roth IRAs can hold the same core funds, aligning tax advantages with long-term compounding and simple rebalancing rules. Taxable brokerage accounts remain a flexible home for index funds tied to medium and long-term goals, especially when distributions are modest and reinvestment is automatic. If building from scratch, a practical Core 3 looks like Total U.S. stock, Total International stock, and Total Bond index funds, scaled to your target stock divided by bond mix. This captures global equity growth potential alongside bond ballast that dampens volatility and funds near-term needs. Small tweaks based on age, time horizon, and risk tolerance are fine, but simplicity supports discipline, and discipline is what compounds. Pairing index funds with a fixed contribution schedule turns market turbulence into a mechanical share accumulation engine. Dollar cost averaging investing a set amount on a set cadence buys more shares when prices are lower and fewer when they're higher, while your index fund quietly keeps you breadth exposed at low cost. Turn on dividend and interest reinvestment so every distribution buys more units by default, keeping your base growing between contributions without manual effort. Expect volatility and plan for it in advance. Even broad markets go through drawdowns, and the best way to capture the full recovery is to remain invested and keep the routine running. Write down simple rules like annual or band-based rebalancing and avoid headline-driven allocation changes so your process, not your mood, decides. Measure success the way index funds are built, after-fee, after-tax results that track the benchmark you chose over multi-year periods. Monitoring tracking difference and expense ratios tells you whether the fund is doing its job. Short-term noise and leaderboards add heat, but not much light. When your fund hugs its index and your behavior hugs your plan, you're set up to capture what the market offers at the cost you intended. The C just adjust as 4. I see just adjust, and Telgen B4 to a 7-4 Tel just adjust as. Avoid common pitfalls that break the quiet machine. Paying high fees for benchmark-like portfolios or chasing last year's hot theme raises risk without reliably improving results. Treat narrow or thematic indexes as satellites at most, not as your core, to keep concentration risks from hijacking your long-term plan. Verify that index funds are truly low-cost, tightly tracking vehicles, not closet-active products with disguised frictions. If desired, factor tilts like small cap, value, or quality can complement a cap-weighted core, but they are optional refinements, not replacements. Keep costs low, size tilts modestly, and judge them over full cycles rather than short bursts of outperformance. Above all, ensure they don't tempt you to tinker with the core that does most of the compounding. Bond index funds deserve a clear role: stability, income, and a source of dry powder for rebalancing. Duration and credit quality explain most of their behavior, so align your bond choice with your time horizon and risk tolerance rather than chasing yield. In practice, broad, high-quality bond indexes complement stock indexes by dampening portfolio swings without trying to time rate cycles. International diversification broadens your growth and currency exposure beyond a single economy, which can reduce home country bias risks. Developed and emerging markets each play a role. The key is to keep costs low and allocations simple enough to maintain through cycles. A total international index paired with a total U.S. index makes global diversification an on-ramp, not a research project. Thank you for watching. Video Due. Here's how to put the quiet machine on rails. Pick your core index funds, set a contribution schedule aligned to your pay cycle, and enable automatic reinvestment of all distributions. Establish rebalancing bands, say 5% around target so adjustments are mechanical and infrequent, then add an annual review to sanity check fees and tracking difference. Document your plan so the next market headline changes nothing about what the next deposit buys. The real edge isn't a hot take. It's fewer choices and fewer errors. Index funds cut the number of decisions you need to get right and free your attention to keep doing the few things that matter. Contribute, diversify, reinvest, and wait. That discipline compounds, and compounding is the quiet part of wealth building most people only notice years later. All of this ties back to the recent focus on schedules over guesses. Your DCA habit is the engine, and broad, low-cost index funds are the vehicle built for that engine. Keep the calendar, keep the breadth, and keep reinvesting, and the snowball you started in earlier episodes keeps growing without a single perfect timing call. Next up, explore ETFs, the more flexible cousin of index funds with the same broad market reach, intraday trading, and practical differences that matter for your plan, including cost, taxes, and how to automate in U.S. accounts.